Yo, what's going on? It's your boy, The Glue. Me and the team, we doing a series of videos to better help people understand options, how to get in and out of trades, what is an option. I know it can be confusing. So, yeah, let's get into it. Like I said, options can be confusing, and most people really don't like it because they don't understand it. That's why most people just prefer to trade stocks because it's simple and it's easy to get in and out. It's a safe investment. Um, stocks, buying and selling stocks is less intimidating. Most people jump into penny stocks first. I know I did when I first started out. I didn't really know too much about options. I had to educate myself, and me and the team, we trying to cut your learning curve down a little faster, and so you can jump in with us, and as we make our trades, you can follow along, better understand what we're talking about. So yeah, time to level up. Options are definitely more lucrative. They limit your risk because if you buy an option, we're going to get into what I'm about to say. I'm explaining more in more slides, in the previous slides. Next slides, I'll explain it more. But if you buy an option and the strike price costs, let's say $1, so that's $100, and if it go to zero, well, you just lost $100, right? So your risk is limited. You're not going to lose your whole account. The return on options is a whole lot greater than buying options. So, as you can see, this is a Google chart. On the left, this is a stock chart. And on the right, this is your options chain chart. So, on the left, you can see they both are time stamped at the exact same spot at the open of the 31st of January 2025. Well, if you was to buy in at $202.80 and you sold at the high at 206.64, well, you would have made $4, right? Versus you buying a one contract at $5.61, which you would have paid $561, and if you was to sell at the high at 741, well, you would have made $180. You see the difference? You rather make $4 or you rather make $180 in one day. That's why a lot of people trade options, and it's because it's a lot more lucrative. You can make more money. Um, so yeah, I'll get into the different pricing because you can definitely buy in options a lot cheaper than $561. Depending on what you're trading, they 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 might be a little bit more expensive, and expiration dates and strike prices and stuff like that, but we'll get into that. So pretty much when you're buying the options contract, either you're going to be buying a put or you're going to be buying a call. So if you're buying a put, you're betting that the price goes down. You're bearish. When you hear someone say that they're bearish, they're betting that the stock market goes down. If you hear someone says they're bullish, they're betting that the stock market goes up. But in the options world, it's a call and it's a put. So if you're buying a call, you're betting that the price goes up. And if you're buying a put, you're betting that the price goes down. You have a set price and you have a certain date. So that certain date is the expiration of when it will expire. So, like I said, you have a set price. That's your strike. Just like I know a lot of people are into FanDuel, they do sports betting and such, and a lot of people can relate to what I'm about to say here next. Let's say you're betting the over under of a player for the game. Well, that over under will be your strike. Whatever that point strike that you're betting against, that is your strike. And the expiration will be 0-0 at the end of the game. right? So let's say you're betting the over under of the game. Let's say the first quarter or the second quarter. Expiration will be the first quarter or the second quarter, and your strike will be the over or the under. The over will be a call, the under will be a put, right? So if you're betting the over or the under, that's your strike. And the expiration will be either the first quarter, second quarter, or the whole game, 0-0. Once it expires, either you're in the money or you're out the money. And if you're out the money, then you lost. If you're in the money, then you just made some money. So here we're going to get into how to actually open a trade. So, like I said, if you're betting the over, that's your call. You're bullish. If you're betting the under, that's your put. You're bearish, right? So in this case, this is NVIDIA, and the stock price is currently at 127 cents. If we're betting a call, everything above this price, so anything above 120.07 is in the money. So 120 is considered in the money, right? 119, 118, 117, 116, those are in the money. So if you buy a strike price at 121, 122, you're out the money. But you have until February 7th for that expiration. The closer the price get to your strike, the more valuable your strike becomes, the more valuable your contracts become, and it moves up in value, and it moves up in value pretty fast. Vice versa with puts. Anything over the current price, so 120.07, so 121 is in the money, 122, 123 in the money, 120, 119, 118 is out the money. So it's just the opposite. You're betting that the price goes down. So if you buy 119 at a current price of 120, you're out the money. But you can buy in the money also. There's nothing wrong with that. It's actually a pretty good idea to do it, but most people don't because they want the cheaper value. But you need to make sure that price is going to go in your direction. And as price move closer to your direction, well, this 320 is going to move up in value. And as it moves up in value, your account is going to move up in value. You're going to gain more money a lot faster than just buying a stock for $120. So to enter a trade, you got your bid and you have your ask. The bid is what people are willing to pay for this strike. The bid, the stock market it's an auction. You got bidders and you got sellers. You got buyers and you have sellers. So these are the prices that they're willing to buy, and these are the prices that they're willing to sell at. The more valuable it comes, the closer the price get to your strike, the more valuable it becomes. So people are willing to pay more for it because it's either in the money or it's out the money. And to simply open a trade, you will either click on the bid, which would be you can either click on the bid, which would be considered a limit order, or you can click on the ask, what would be considered a market order, meaning you want to get straight in. You don't care about waiting for price to get down to that price. I want to get in now. Let me get in now, right? So you will simply click on which one, and you can change the date. As you can see, these are puts, right? So the farther away you go, the cheaper it is, right? But you want to make sure you got some volume so that you can get in and out. You want it to be lucrative. You want it to be volatile so that you don't have to be like 74 volume. this will be hard to get out of if you were in, because it's not too many participants. It's an auction. You want to be where people. You want to be where people are, and the volume is people, right? You want to be with the masses so that you can get in and out your trade. So let's say we get a February 14th expiration with $107 strike, and it's currently at $1.90, right? Currently at $1.90. Well, as you can see, 10 contracts is $1,900. So you get one contract is $190, $1.19, right? Times 100. That's where you get your value. That's where you get the price that you will actually pay. Times this by 100. As price move in your direction, this will move once you're already in. So one contract, every cent it moves is $1. So if you had 10 contracts, every cent it moves is $10. Every dollar it moves is $100. And it will move based off of your strike and where the price is compared to your strike. So we have 107. Nvidia is currently at, like we said, $120, right? So if Nvidia get down to $110, well, you just made some money. I can't really calculate what it would be. There are ways of doing that, but in this example, that's not what it is. Vice versa. Let's look at Apple. They're all the same. You want to look at your volume because you want to be able to get in and out of a trade. This is Apple. As you can see, the value of the contracts changes. Some companies are a lot more expensive than others. What company you're doing, not all companies are optionable. But you will learn that. You will see that some companies are optionable, but you just don't want to trade options in them because they don't have volume. A lot of people aren't trading options in those companies. So you just want to make sure you pay attention to the volume, because that's how fast you will be able to get in and out, and the spread of the bid and the ask. As you can see, this is a 40-cent spread, 8-cent spread, because this is in the money down here. These are puts. So yeah, pretty much we're putting this together so that y'all, we can have y'all better follow us along as we start doing these $1,000 challenges, $500 challenges. So when we say we're getting in 221 app Nvidia, let's say we're getting in 221 Nvidia $133 call, right? Where we're out the money. But we have until the 21st of February for this to actually become effective for us in our pockets. So this is the expiration, and we're betting that price goes up. Even if price don't get to our 132, let's say it gets to 128, well, this is still going to gain value because it's moving from 120 to 128. So it just made an $8 move, and we have a 132 call. Well, this $3 might go to $6. And if you have one contract, you just made $300. Well, if you had 10 contracts, you just made $3,000. But you would have paid $3,000 because 300 times 10, 3,000. You get one contract, 300, right? Two contracts, 600, right? And if this $3 strike, this $3 price that you bought in at for this 132 strike, for this 221 expiration goes to 128, well, this $3 will gain value, and let's say, like I said, it might go to $6. Well, go to $6. And you have two contracts, well, you just made $1,200, right? It's that simple. But the main purpose of this video is to help you all follow along in what we're talking about. Remember, strike is the price that we want it to move towards, and even or pass. And if it passed, then that's in our favor. A call, you want price to go up. A put, you want price to go down. I hope this video was helpful. There will be more in the future. You can always ask questions in the Discord, or you can write a comment or something in the YouTube. But yeah, peace.